So, unlike the single form W-9, the W-8 series includes multiple forms, and each used for a different type of account holder or a different tax situation. So, for example, you have the W-8 BIN for individuals, you have the BIN-E for entities, the EXP for tax-exempt organizations, for example. You have the ECI for effectively connected income. You have the IMY for intermediaries and flow-through entities, along with like supporting documentation, which may be withholding statements. And not to mention the often forgotten 8233 for service exemptions. All of these different forms W-8 comparatively to the half a page W-9. Organizations must not only determine that a W-8 is in fact required, but they also will need to be able to validate the W-8 that is ultimately supplied by their customer. And as we just discussed, there are many. Most forms W-8, they're several pages long. They require far more information, again, than like the half a page W-9. That also means that there's more validations to perform, ranging from a field by field checklist, perhaps, and reviewing things like tax treaty claims for validity. W-8s have a built-in expiration cycle, and that expiration is at the end of 3 years towards the end of the calendar year after they're signed. So, for example, if you collect a BIN-E or W-8 BIN in July of 2022, that form is due to expire December 31st, 2025. So it's due to expire at the end of this year if you collected that form in 2022. So you can see the complexities here from a validation perspective, a collection perspective, a tracking and management perspective. So what does that really mean for you in practice? First and foremost, you need a tracking system that's ideally not Excel, by the way, but you need a tracking system that's going to actively monitor for form expirations because you want visibility into upcoming expirations well in advance of a tax form expiring, whether it's a W-8 coming to its true natural end of life or whether it's a tax form that's expiring due to a change in circumstance. There are real consequences if a form expires and you don't have an updated form on file. Example, if a customer was claimed a treaty and they're receiving a reduced rate of withholding, but that form expires. If that form has expired, they are no longer entitled to that reduced rate. And if they've not submitted a new form, again, ahead of that expiration to continue that treaty claim, then you're required to withhold at the default rate of 30%, assuming this is, again, a non-US person getting paid US source income in the treaty claim. So this is a perfect example of how what happens at the front really directly impacts how you withhold and what you report on.